Hi, welcome to the Cash Money's channel. I'm just going to talk today about the ESPP, that stands for Employee Stock Purchase Plan. It's basically when your employer takes money from your payroll and they buy company stock at a discount. Usually it's 10 to 15%. And usually is at the end of a 6-month period where they take your payroll for 6 months and then they purchase the stock. And you can change the contribution every 6 months, or you could also enroll or stop enrollment every 6 months. And the IRS restricts a total dollar amount of $25,000 per calendar year that you could contribute to your ESPP. I'm going to put a graphic up here on my left. It's basically a diagram of what happens. You give your company money from your payroll, the company buys stock every 6 months, and then they give you the stock, and you can either sell right away after the 6 months, or you can wait 1.5 years. And I'll go into advantages and disadvantages of those options. And I just also want to talk about the offering date usually occurs at the end of December and the end of May, and the company buys the stock at the beginning of January and June. And they designate your contribution rate. Some employers limit it to 10%, so you could only contribute max from your payroll a 10% contribution. And others may be higher or lower, it just depends on your employer. And if you sell in less than 2 years, it will be deemed a short-term gains tax. If you have any gains on those shares, they'll be taxed at a short-term gains rate, and that's usually at your current tax bracket. And if you hold it for 2 years or greater, so you get the stock after the shares after 6 months, and then you have to wait additional 1.5 years, and then when you sell it, you'll get a long-term gains tax rate. If you get any gains on that, it'll be deemed a long-term gains tax, and that's usually at a 15% tax rate. And then once the company buys the stock, you really only have to hold it for 1.5 years, because 6 months would have passed within the offering period. And the brokerage you use for the ESPP will also tell you which lot of shares are long-term or short-term gains tax. So they'll have like a little box, it'll tell you whether it's a short-term gain or a long-term gain. And that'll help you know when to sell, or if you want to hold on to it until it becomes long-term. And then I just wanted to give an example here. The company offers you to enroll in the ESPP. Basically, it'll be, for example, January 1st, 2021, and then the company can purchase the stock on 6/1/2021, and then you can sell it for short-term gains on 6/1/2021 to 12/31/2022, and then you would have to wait to sell for a long-term gains on 1/1/2023 and onwards. And then it's almost like free money when you enroll in your ESPP. It's kind of like your 401k match, and if you don't participate, you will never get the discount, and it'll be sort of like a missed opportunity. And every year that you don't participate, the larger the missed opportunity. It's better to take advantage while you can. And there's a phrase that says scared money doesn't make money, and you got to keep playing the game. And so I regret not doing it in 2010 during my first 2 to 3 years of employment with one of my previous employers. I could have bought the stock at $30 and got a 15% discount, and then 2 or 3 years later, I could have sold it for over $100 with that discount. So I would have more than 3x'd my money that I put in, and to this day, I regret that, because that could have paid off my student loans 3 times faster at that time. The company's also giving you an edge when they offer ESPP, because it helps the company's stock price and also helps you as the shareholder. And discount the company gives you is free money if you sell right away. You'll just get the discount that the company gives you. And I'm going to give you an example here. So say you make $100,000 per year, just to keep the numbers even. You elect to give 10% to your ESPP annually. Your company gives you a 15% discount on the stock, and so the company buys $5,000 for you every 6 months from the payroll that you give them, for a total of $10,000 worth of stock per year. And the stock is worth, say the stock price is worth about $100 at month 6, and then the stock is worth around $150 at month 12. So if you sell right away, every 6 months you will earn $1,760 gain and get back your $10,000. So you only have to pay tax on the $1,760. So you would buy 58.8 shares at month 6, then you would buy 39.2 shares at month 12, and then that's how, if you keep selling those right away after those 6 months, you'll get about $5,880 or $880 of profit every 6 months, which will equal that $1,760 at the end of the first year. Only the $1,760 would be taxed at your current tax rate, which would be anywhere from 15 to 30% depending on your annual income. But if you waited 2 years and say the stock price was at 150 after those 2 years, you would have gained $14,700, and $4,700 would be gains, and then you would only get tax on that $4,700 at a 15% tax rate. So, and it also could be lower depending on your tax bracket as well. I mean, there's sometimes you don't have to pay any tax on long-term gains if you make below a certain threshold. So just imagine if it increased to $200, the stock price, and you kept all those ESPP lots. I mean, imagine how much that would be then. As your company stock increases, your shares of those ESPP with your discount would also increase tremendously. The only downside is waiting 2 years. Those 2 years puts you at risk with the company volatility in their stock price, and so if it does decrease below the discounted price you bought it at, you also lose money. So, and you want to basically probably look at your company and look at their charts, just their whole company chart all since the beginning of time, and then also maybe like a 2-year or 1-year chart, just to see if their company stock price has an uptrending trend, and that would help you make the decision of whether you want to keep it long term or only short term. If it's uptrending, then go ahead. I would probably keep it long term for those 2 years. If it's trading sideways, going up and down, but not really the trend line's not increasing upwards, then I would probably still buy it, but then I would only sell it when it's trading sideways towards the top. And then if it's downtrending and the company's stock is just decreasing every year, I would just sell right away. After those 6 months, they give you the opportunity to sell. I would just sell it right away. And let's see. Then I just want to talk about basically the three options that you have. So you could either sell right away, and I know people who just sell right away. I've done it my first year when I started ESPP. I just sold right away and just took the short-term gains profits. Gains are gains. You're gonna earn money either way if you just sell right away. There's less stock risk, so you would just receive the company discount, but you have to pay the higher tax rate. And then there's people who also, that I know of also, that they never sell. So they never sell their ESPP. They just hold on to it. They have the highest stock market risk because they have more shares in that company in their ESPP, and it's just building over time because they never sell it. And there's potential for high gains, but also for loss. And just 2 examples. If you were an employee of Tesla and you held all those shares since the beginning of that company's startup, I mean, you would have been probably a millionaire by now. But if you were in another company like Enron and you held all those shares and they went bankrupt, you would own nothing right now. So that's just the 2 extremes of if you never sell your ESPP shares. And you also get a long-term gains tax rate when you sell. But one of the things I've come across is when I was talking to my coworkers, some of them were doing a laddering approach, and I thought this was the best approach. So I started doing it, and I've enjoyed all the gains from it. So you sell one lot of shares every 2 years. So you build up 2 years of ESPP shares, and then every 6 months after that 2 years, you sell one lot of ESPP shares, and then another 6 months come by, and you sell the second lot, and you just sell the oldest lot for the long-term gain potential. So you're selling at a long-term gains rate. You have moderate stock risk, and then you have the potential to receive the stock price appreciation and also the company stock discount. I'll put another little diagram here of what I'm doing. It's basically you just give the company money from your payroll for 2 years. The company buys the stock every 6 months for 2 years. Then after the 2 years, you sell one lot or 6 months of shares, the long-term shares every 6 months, and then just keep on repeating that. And basically, you use that money for vacations every 6 months. You could use that money for investments every 6 months, and you don't have such a large amount in your ESPP shares in your company that if your company tanks or goes through a bad time, it doesn't affect you adversely too much, because you only have 2 years worth of shares in there. You don't have your whole life savings worth of shares in it. And I feel like it's a good short-term emergency fund for you to pull on every 6 months. So you're never feeling too stressed out or anything like that. So if you have any comments or feedback, please put them down in the comments below. Any ideas for next videos, also put that down in the comments below. And thank you to all my subscribers, and you have a wonderful day. Let's make some cash. Thank you.